Hello and welcome to the last session of our three-day event. We are joined now by Mike Seidenberg, who is co-manager of the Allianz Technology Trust. The team is based right in the action in San Francisco, where Mike is talking to us from. We're also joined by our friends at Interactive Investor, and Kyle Caldwell will be curating the Q&A session at the end. Please do use the box at the bottom right-hand corner of your screen to submit questions. I'm sure Mike will much enjoy answering them. So we'll do about 25-minute presentation from Mike and then over to those Q&As. So thank you very much, Mike. Over to you.
Great. First of all, thanks everyone for their time today. I appreciate it. I know people are busy and there's a lot going on, so I appreciate your attention to me. Fun. So, my name is Mike Seidenberg. I'm one of the portfolio managers on the Allianz Technology Trust. We are part of a larger technology area of focus at Allianz. Collectively, manage about $27 billion across a variety of funds. What's pictured here are the dedicated resources that work across the various funds and strategy. Ironically, I just got off a call with these folks, so it's a very interactive process amongst the various teams and portfolios. But here's the team that I work on and the members of the team. We collectively manage approximately $11 billion in change, and ATT is a very important product within our franchise. It's a team of 5 people, of which we have myself and Walter as the 2 primary portfolio managers on this fund at this point. We all kind of have areas of domain expertise. And if you've met with me before, it's a very iterative and collaborative process that we work around, which is, depending on, and let me just kind of pick one of my team members, Danny Su. His background is in semiconductors. He actually worked for Booz Allen prior to working on the sell side and then moved to the buy side. He has a lot of responsibility for our Asia supply chain, semiconductor related components. But I want to point out that for anyone to get a name in and out of the portfolio, it really requires you to kind of bring your teammates on with the idea in order to gross up that position. And what that really means in layman terms is to make something bigger, it can't just be Mike Seidenberg thinking that XYZ can be 3%. It requires your coworkers to really kind of buy off on why a position should be a certain size. So there are 5 of us. I think it's interesting. People kind of ask me, what's the team like? I think at our core, I think the reason why we've kind of worked together well and why we have a long-term track record is we're just very curious people. We're product people. We really love technology, and a number of us have engineering/tech backgrounds, right? Whether it's Walter with a double E major, whether it's Hua Chen with an engineering background. It's my background is one of sales operations prior to being on the buy side. And Rich Gorman, who we just hired, was actually he was in investment banking. So we all have kind of varying backgrounds, but the key component is this kind of intellectual curiosity, which kind of leads us to kind of look at products and services and how they're meeting the needs of technology buyers. And we think that kind of leads ourselves to good outcomes with respect to finding companies to invest in. So, people ask us, how do we operate? What's our kind of core philosophy? So at our core, we really think of technology as a winner's game, not a loser's game, and that there are opportunities to create subsectors that garner lots of investment by their customers. And I'll give you my own example. that I've seen in my career, one of many. But if I think about my time at Oracle Corporation, which I worked at, 20 years ago, and I think about cybersecurity, right? Cybersecurity was part of the software budget at that point, right? So if you were to look at a chief information officer's budget, cybersecurity was embedded in software. Roll the clock forward 20 years, and you would see that cybersecurity is its own line item, right? It is garnering budgetary dollars independent of other software investment, primarily because it's such an important sector. So when we think about this winner's game aspect of the business, we really think in terms of identifying subsectors that we think are going to be able to kind of, almost kind of, birth themselves into that budgetary process and be part of an ongoing spend that companies spend in and out. Now, year in and year out. Now, obviously, that is going to vary depending on the year, depending on the economy, et cetera, et cetera. But that's kind of that's how we think about this winner's game, right? We also think that given technology and the rate of change, which is super high, we think that we can mitigate risk by really understanding who the market leaders are and investing in them, as opposed to potentially looking at a secondary or tertiary player in that space. We really try to identify the leaders of the subsector and spend time with them to understand what is it about them that makes them unique, that are going to allow them to kind of have persistence over the relevancy of that subsector. So those are kind of two key tenets, and I'll go into later on how we get there, but those are kind of two key tenets with respect to our philosophy. Obviously it goes without saying that, given the importance of technology today, from a portfolio management perspective and from a construction perspective, we have the ability to really kind of create a diverse portfolio within technology. So looking at various subsectors and various industry diversification within the framework of technology, and then kind of par and parcel with this whole process is really using the Allianz grassroots research process. And for those of you that don't know about it, let me just spend a minute on it. Grassroots is an organization that basically talks to customers and does survey work. And for example, and I'll give you an example in my career that we used it very effectively. Probably 8 or 9 years ago, we were looking at Netflix, and they were making the move from DVD to video on demand using the internet. And I had a core thesis, which was people buying iPads were actually going to subscribe to Netflix. So I wrote out a series of questions that were then executed upon via our grassroots organization. Now, these are not investors, right? Grassroots is an independent organization, and I'm not allowed to be on those calls when they're asking customers questions or trying to figure out the answer to their questions. It is purely a reporting organization. And what we learned in the example with Netflix was people that were buying iPads were in fact going to subscribe to Netflix. So it gave us conviction in that position to make it a larger position. And obviously, hindsight's 2020, but this was a super important aspect of their company, and it obviously resulted in the stock having lots and lots of appreciation. So we use them for consumer products. We use them for spending trends. I will tell you, it's a little more difficult as we get deeper and deeper into the IT spend, just from a grasping perspective. But they're an important part of our process. If I think about technology today, it's a reasonably mature sector, which allows us to create portfolios that have value aspects as well as shareholder activist aspects. So it really, this diversification and this growth of technology has created opportunities for people like activists to get involved, share buybacks, consolidation, et cetera, et cetera. So really a very diverse offering now in technology. So what is our process, right? And I think, if you only remember one slide from this presentation, this is the slide I would focus on. It's this mosaic, right? It's this idea of this circle. And I make the argument you can go either direction in the circle, but let's start on the left. Just really, people my kids will ask me, what do I do on a daily basis? And one of the things I say to them is, I listen. We spend a lot of time listening to CIOs, listening to system integrators, and really understanding, what products and services are making their lives easier. Where is spend being allocated in today's environment? And that just requires, spending time at trade shows, going on, listening to seminars, et cetera, et cetera. And that kind of enables us to identify these growth trends, right? And once we identify the growth trend, that allows us then to kind of look at the sector of which that trend could be a part of, or that kind of budgetary spend is a part of. And then we can identify the companies within that sector and really kind of understand, what are their business models? How do they think about, going to market? What are the barriers to entry? I mean, I often tell investors, we've looked at a lot of sectors historically, and we just didn't understand the risk return, and we didn't understand why we needed to pay such a high multiple for a company that we didn't think was that kind of protected from a barrier to entry perspective. So, part of this job, part of the process in this job is you spend a lot of time talking, and looking at companies where you end up not investing in them. And we're okay with that because, that's just part of the process of identifying who the leaders are. And once we understand who the leaders are and what the subsectors are that we're attracted to, then we kind of that next process, which is spending more time with that company. Obviously, most companies report 4 times a year. That gives us a snapshot into their business, but we don't just kind of depend on companies, the quarterly reports. We go to their user groups, we go to industry trade shows, we go down and actually spend time with the company on their turf. So, I was at Morgan Stanley Tech Conference, not last week, but the week before. We probably met with 40 to 50 companies during that process. But that's what I call kind of speed dating, right? It's a 25-minute meeting. Sometimes we're sharing that meeting with another fund. We really like to go down and meet with the company. And when I say go down, I'm just saying it euphemistically. We go to wherever the business is. I've spent a decent amount of time in Oklahoma City, which is where one of our bigger positions a few years ago was domiciled. So we go to where the business is, and the net output of these 3 stages is creating a portfolio that is diverse with respect to market cap, diverse with respect to valuation characteristics, and diverse with respect to subsectors. So this really highlights our process and kind of what I think our competitive differentiation is for some of our peers. So, the highlight, just thinking about the team, the two founding portfolio managers have worked together greater than 30 years now, which I just think is just a testament to their longevity. I've now been with the team north of, I think I'm going on my 13th year here, which is pretty amazing. We all the team members have at least kind of 15 to 20 years worth of investing experience. And we kind of have this consistent, philosophy process with respect to how we've run our portfolios from day one. And we think that, that kind of allows us to kind of have exposure to the themes that matter over time. It's a global product. At times we could have up to 50% of the revenues outside of the US. Inevitably, someone's going to ask me in Q&A, most of the companies are actually domiciled in the US, but that doesn't mean that their revenues are actually coming from the United States. But a lot of the headquarters actually are in the US. Our process really leads us to focusing on these mid-cap companies that have the ability to grow and to become part of a larger theme and technology. And that's where you get that appreciation as companies go from mid-cap to large cap. It's a fairly concentrated portfolio, and we think being in San Francisco is a competitive advantage. We spend a lot of time, I used to jokingly say we went to the Silicon Valley all the time. The irony is that so many of the companies that are relevant and are kind of in our backyard, literally, blocks away from the office. So we think, frequency and ability to meet with these companies is something that we kind of pride ourselves on doing. And we think the geography affords itself some advantages. So as I alluded to, robust performance over multiple decades. This just kind of highlights some of the characteristics, and I hit on these. I hit on some of these earlier in the presentation, but understanding that we have these high growth, innovative companies that are over investing in sales and marketing. A lot of these models are subscription models, so the revenue comes off the balance sheet in very thin slices, yet you're incurring the cost of sale at time. They tend to be not very profitable, and they're what these are. A lot of these companies are growing kind of plus 20 to 50% growth rates. That's a slice of our portfolio. GARPy companies further along in the maturation process, more profitable, probably not growing as fast. On these particular companies, we tend to look at things like a PE ratio, whereas in the more high growth companies, we may actually need to go out a few years and look at a cash flow multiple in addition to a revenue multiple from a valuation perspective. And lastly, we have our attractively valued companies, right? Mature companies, maybe it's a product cycle, maybe it's Oracle, being able to kind of, garner some cloud dollars. Maybe it's the scenario that we had a few years ago where we had Micron in DRAM with less competitors in the market. Therefore, the pricing was better in that space, which allowed those stocks, both Micron as well as Samsung, it was the DRAM space, allowing both those companies to really monetize that space better because there were less competitors. This just highlights the PE ratio of the fund vis-a-vis the S&P 500. Look, I had I lived through the dot-com bubble. I would make the argument. I was just having this conversation with the CEO of Atlassian last week when I was fortunately able to have lunch with him, which was just an amazing opportunity just because I'm such a fan of the company. But we were talking about the difference between now and the tech bubble, where so many of the companies during the tech bubble really did not have product, right? The nature of how you basically bought that product was different. Versus today, where it's a subscription, right? And a subscription is great for the company and it's great for the customer, because if the company doesn't really have a product and I'm on a subscription, I can walk away. So I do think it's different than what we saw, in the dot-com, where I just saw so many kind of crazy ideas come to market that really weren't, I always jokingly say, I don't care if you have a website. Shipping bricks, coast to coast doesn't make sense because they're heavy. So, I think this is a different advantage and a different environment. It was really interesting talking to Michael Cannon-Brookes from Atlassian with respect to kind of how he was talking about the companies really having much more duration. And he wasn't talking about Atlassian per se. He was talking about some of the public companies that had gone public. So, so tech is more expensive than the S&P 500. Obviously, the beginning of this year has been very difficult for tech stocks as we've kind of have a number of headwinds putting pressure on the group. But what are some of the drivers as we think about, kind of a multi-year time frame? It's this idea that, companies having to re-platform, right? Moving from legacy to the cloud. That's a $1.7 trillion opportunity, and we're still early days in that journey. And that is something in my career. I was at Oracle when people went from mainframes to client server, and now people are going from their existing infrastructure to the cloud, right? Just a much more variable cost environment, which is great for if you're in part of that kind of wheelhouse of spin, which we try to identify customers that are in that. This is just highlights the thing I just kind of talked about, which are these are the various cycles we've seen over a multi-decade perspective in technology. It's mainframe, it's the internet, and now we're living in the era of artificial intelligence and big data. And I often like to bring these kind of concepts down because I remind myself artificial intelligence and big data is just being enabled because we have cheap compute and storage. So when I worked in industry, we knew the questions to ask. We just couldn't get the big data sets and manipulate them in a cost effective manner in order to answer them sometimes because we were using very proprietary methods. And now we're living in a world where you're able to look at cheap compute and storage, and that just allows companies to answer lots of questions that their customers have, and that's a real good thing. So just bringing this concept down so we all can understand it. This is the fund with our performance over a multi-year time frame. We did underperform last year. It's something we're not happy about, and we're trying to obviously remedy that. But you can see over a multi-year time period, we've outperformed um, we've outperformed our index, and we've been able to execute and drive shareholder return. So what have been the drivers year to date? We've underperformed. We underperformed our benchmark over the calendar year, mainly due to some rotation, rotation into some of the mega caps and more cyclical companies. We started making that change in the portfolio in June. We weren't fast enough, and it hurt us. We've been hurt by, things like Microsoft and Google. We got Amazon wrong. We got some high growth software companies wrong. We've had some companies help us. Tesla has helped us. Zscaler, which is a security company, has helped us. Asana, which is a company we have just a stub position left in. We were part of that appreciation, and then we just couldn't understand the risk reward, and we sold the companies. And we've had a exposure to some semiconductor companies that have helped us. So moving on, and I want to be cognizant of time. So this just kind of shows you our top 10 holdings. Look, I think it's really worth noting our board is a very active board. They are the most engaged of any fund we run. And people often ask us, why aren't you at benchmark in Apple? Why aren't you at benchmark in a company like a Microsoft? And the answer is, look, we have a board that really cares about position sizing and really single stock exposure. And we care as a portfolio team as well. So we understand that there are periods of time where we're going to underperform when mega caps outperform because we're just not going to be at the benchmark. And that's a headwind. It's something, we like to try to offset. And some years were better than others. But I think at the end of the day, you as investors can rest assured that you have a board that really is benchmark aware, but not benchmark driven, as are we, and really thinks about, what does it mean to own 15% in a single name in a supposedly diversified fund? We have very healthy discussions as positions go above kind of 7% in our fund. We have a very healthy discussion with them. So, I think that the fact that they are so involved really speaks to long-term performance and not being caught and whipsawed vis-a-vis single positions. And we can come back, obviously, to all these during Q&A because it's just me talking. Just kind of highlighting this just kind of highlights where the portfolio is positioned. Not surprisingly, underweight mega caps, overweight large and mid cap. The number of holdings, we run a concentrated portfolio. That portfolio has better growth EPS characteristics vis-a-vis the benchmark, and we're paying a modest premium to the benchmark for much healthier multi-year EPS growth. So we're comfortable with that. We think that that the companies that are as these companies mature, they become very profitable, and therefore the earnings growth kind of flows out of them. So diversified across multiple themes. Some of the things we're excited about, and collaboration. I think if anything, this pandemic has showed us that companies need to be flexible with respect to how employees work. I think hybrid is the new normal for most people, and we think collaboration becomes increasingly important as companies realize they have to get things out the door, right? In collaboration, there are lots of companies working on really interesting collaborative environments, whether that's a developer environment on the engineering side, or whether that's a market collaboration environment on the marketing and sales side. Continue to see interesting opportunities in advertising and retail. Here again, we're going to come out of this pandemic more and more kind of dependent on this little device, as people kind of allocate time away from television more towards digital. We think that manufacturing is an important aspect for many companies, especially for companies in countries like the UK and the US, where we have high labor rates. We're going to need to have companies that make people more efficient with respect to manufacturing. We've seen this whole trend with respect to people not going back to work, and kind of how does that impact ability to hire, ability to produce things. And it's been a real challenge. I mean, I think it goes without saying, electrification of vehicles, it's not a fad. It is the future. We're seeing it. The amount of semiconductor content in these cars are sometimes up to 4 or 5 times X a traditional automobile. And regardless, even in the core automobile sector, we're seeing lots of opportunities as you see more safety features, more digital content come in. So we're excited about technology. We think it's a theme with respect to rapid change. It's kind of we're calling this the golden age of technology. The environment remains robust for spending, even with all the worry about the conflict in Ukraine and Russia. We're still seeing very healthy spend by companies as they report. So we think that the technology sector can provide some of the best relative and absolute stock returns. So let me just run through these examples really quickly, and then we'll go to QA. So I just alluded to the global labor shortage, which has been exacerbated vis-a-vis the pandemic. You can just see on some of these slides, we have this decreasing worker population, and it's a shortage of labor. And by the way, changing that is very difficult. It requires people to change their birth rates, and that usually takes 5 to 10 years at least. So the excess labor supply is gone. What does this mean? Well, it usually means that technology steps in, and the spend goes up as a percentage of GDP, which is being highlighted over these cycles that we've seen previously. So that's something we're really excited about. And this just another slide highlighting it. So I know it's a lot of information in a short period of time. So obviously, if there's any follow-up post Q&A, we can do that. But I'll pause here and we'll go to Q&A.
Great.
Thanks so much, Mike. Oh, over to you, Kyle.
Great. Thank you very much, Mike.
You're welcome.
So, hi everyone. I'm Kyle Caldwell. I'm the collectives editor at Interactive Investor, and I'll be moderating the Q&A. So if you'd like to ask a question, please put it in the Q&A box, and I'll try my best to get to it within the 15 minutes that we have. So, Mike, I want to start off with the recently published annual report announced that you'll be taking over as lead portfolio manager of the trust in July, and that Walter Price will support you until the end of the year. Is there any more information at this stage that you can share with us regarding that?
Yeah, I mean, so Walter will not be the lead PM on this portfolio. As of July 1st, he and I will be working together. I've worked with him closely daily for the last, 12 plus years. So he's been an amazing mentor. We have so much pride associated with this product. I would assume we continue to add resources to our technology franchise. As the slide highlighted at the very beginning, this is a really important strategy for Allianz. So I would assume we add resources to the strategy over time. Look, we were talking before the call, and I have just the utmost respect for both Walter and Hua Chen, just the way they handle themselves and the way they kind of come to work every day and kind of I jokingly said they bring it every day, right? They care. They're constantly working on the portfolios across our funds. So nothing to add at this point other than I will miss him, and I look forward to working with him through the remainder of the year. And I know he has stated he will remain a significant, he will remain an investor in the trust.
I wanted to next get your thoughts on a line that was in the annual report from the chair, which said that technology valuations have undeniably raced ahead over the past few years. What's your view? Do you think we could be in for a period of more modest returns for tech shares, given the tightening of monetary policy?
So I think that so the quick answer is yes, with the caveat, I think it'll be more of a have and have nots market that we're living in. I think that what we saw once the pandemic started in March of 20 was just a broad-based spend against technology, right? Because everybody on this call, we had to get ourselves online in order to do our jobs, in order for the investment advisors to service their clients in a more effective way. So I think there were a lot of beneficiaries of spin in that time period. But I think now we're living in probably, if I were to use an analogy, it's more of a rifle spend approach versus shotgun. And I'm not a hunter, so I'm going to base it that I'm getting the analogy right, but I know I am. But I think that we will see companies that are focused on digital transformation, and we're already seeing it. See good spin, see good growth. And whereas some of the others, maybe it's a legacy company, maybe it's a company that isn't as relevant, not get those dollars that maybe they benefited from during the pandemic. Conversely, themes like cybersecurity, right? If you just think about the Ukrainian-Russian conflict, I mean, it was a lead story, right? And there's still real worry. We had a meeting last week with the CEO of Palo Alto Networks, which is a large security provider, which is a software security provider, a cybersecurity provider, which is in our fund. And he talked about getting call after call from financial institutions that are really worried about what do the Russians do to retaliate as they are kicked out of payment networks. So I think that is an area that we've talked about. If you've met with me before, we have talked about that for years. That sector just remains more relevant and will continue to be relevant. And you'll see real spend against there. Semiconductors for EVs, right? Semiconductors for industrial applications, whether, it's interesting, we had a conversation with the CEO of Wolfspeed, and he was talking about the margins associated with as you electrify some of these power tools for companies, right? Not only are the products better for the in market users, but the margins associated are better for the manufacturer. So, here again, stepping judiciously, but understanding that there'll be growth in a tighter spending environment for companies. And with respect to valuations, absolutely. I think that, as I alluded to, we started to make the change in the summer because we just couldn't get the risk reward to work for a lot of these names. We didn't move nimbly enough. So that's our bad. But we think in a higher interest rate environment, it really forces companies to ask themselves as their cost of capital goes up, how do we invest? But I think at the end of the day, I want to remind all the investors on this call, there's still going to be spend in technology, and we'll still see certain companies, kind of motor through this time period. And the stocks, we're already seeing it with some of the stocks that have gotten really hurt. They're putting up good quarters and they're being rewarded, but I think our framework probably needs to change as the cost of capital goes up.
We've had a question regarding Chinese technology companies. Has China become too much of a political risk? Or in other words, does the political risk of investing in China now outweigh the rewards, particularly given
Yeah,
the political
it's a
interventions that were made last summer?
It's a great question. Look, those of you who here again have met with Walter, myself, and the team know that we were early in China. We were investing in China in 2002, and we very we did not like what was happening, and this was prior to the pandemic. We did not like what was happening with the current political regime there, so we exited China primarily because we couldn't understand the playing field, right? And for me as an investor, not understanding if a government makes a company a pawn in their agenda, that's very difficult for me to explain to you, the investor. So I think the question is spot on. I don't think we know what the political landscape there is with respect to public markets, and therefore, we will eventually and hopefully at some point enter China again. But until we understand what it looks like, I think we'll stay away, because I don't want to answer the question to my investors: why did this company get wiped out by the government, not vis-a-vis the business, right? And then, it's just a risk factor that you have to consider as we look at this, as we look at countries like China.
We have a question regarding Amazon and Netflix. Are they both still in the portfolio?
Netflix is not in the portfolio. Amazon is still in the portfolio. On Netflix, we were fortunate in that we were able to really monetize the stock well. As the business matured and as competition kind of entered the space, it just became more difficult for us to really kind of understand the valuation. So, we were fortunate in that we were able to exit the position. It doesn't mean that we won't enter it again. But, in my career, I'd probably say it's arguably the best stock, I've owned as an investor, and we were able to really understand and have a really, differentiated view on their business. And as it became more mainstream, our ability to differentiate between what we thought and what the rest of the world thought came together, right? And that means that, generally speaking, the opportunity isn't as good for our investors. Amazon, we still think, is in an interesting position. It's been a stock that we've owned for lots of years. It's not as big as it's been previously, but we're excited about. We really, really like. Sorry, I was going to bring it up. I was trying to get you guys to the top 10 holdings, which I'm doing a really bad job of. We really love the AWS business. We think that is a business that has high barriers to entry, good core operating margins, and really good growth characteristics. And by the way, they're in a really incredibly tough market, right? You have the likes of Amazon and Google, beating on you every day, and they're continuing to grow. They grew faster than Amazon did on a bigger base last quarter.
And following the sell-off in technology companies since the beginning of the year, have you been moving to increase gearing levels on the trust? And what is the sort of gearing level range typically?
So we're allowed to use gearing. We've never used it. So it's something that, we would go to the board to ask about. Our primary reason for not using it is there is enough inherent volatility on an inter-year basis with tech without adding gearing to the equation. It may not be the answer our investors want to hear, but it's really the way we think about volatility. Gearing would just potentially add to that volatility. Doesn't mean we would never use it, and but we've never kind of gone to them to ask to use it at this point, as long as we've managed the fund.
Yesterday we had the first of potentially many US interest rate rises this year. With US interest rates forecast to be around 2% over the next couple of years, what impact is that having on your valuation models?
Yeah, I mean, obviously it changes the terminal value, right? Because, that when you do the math on it, look, I still want to remind investors, the economy is running really hot, but there's some headwinds, the conflict is a headwind. We see, we're concerned about, consumers not being as robust, as inflation impacts their wallet. So, you know, the potential for the Fed to be less aggressive is a scenario. But obviously, as we look at companies, you have to factor in those higher interest rates as we think about valuation. And it's not a tailwind, it's a headwind, right? Because there's a difference in cost of capital between basically 0 and 2%. But I often like to remind investors, like you don't have to go back historically to see that this is still a relatively low interest rate environment.
The next question is, does the trust have exposure to unquoted investments?
We get asked this a lot. We don't. Fortunately for us, a lot of the management teams that we deal with, and we do talk to lots of private companies. A lot of the management teams we deal with in our career go from public to private and private to public, and that gives us, familiarity, and hopefully that gives us some type of, goodwill with them when they go public, if we were to participate in the IPO. But we think that I often remind investors that the idea of unquoted is great because everybody reads about the company that went up 30, 40x. But what you have to understand is, as you go down to the Silicon Valley and knock on the VC doors, you don't get to cherry pick their investments, right? You get to invest in all of them. So you get some type of, blended average. And that, we just think that it would require a different type of resource on our team. It doesn't mean we wouldn't do it eventually, but it's not something we've done lately, or with not something here again. It's not something we've done since we've managed the trust.
The metaverse is a relatively new theme for the trust. Could you explain how you're playing that theme and potentially give a couple of stock examples? And as a side note, I think the first metaverse ETF launched on the London Stock Exchange today, in fact.
Excellent. So the metaverse. So look, at its core, the metaverse is a pivot by Facebook, right? What Facebook was realizing, every company wants a direct relationship with their customer, and Facebook was having a more challenging scenario vis-a-vis the likes of Apple with having that direct relationship with their customer. And then obviously par and parcel with that is understanding who that customer is, what she or he kind of does on a daily basis, and what they might want to buy. So metaverse was this pivot, right? And it's this pivot to this alternative universe. And look, I hear people talk about it, and I think that there'll be some traction there. There's committing just billions and billions of dollars of spend, but I would say at the margin we're in a wait and see on it. In that I'm a little bit skeptical of people spending an inordinate amount of hours, with a VR headset on. And here again, I could be wrong, and I could be old, which also could make me wrong. But if I watch my kids, one of whom is 17 and the other, my daughter, is 14, they don't seem to have any interest in the metaverse, and nor do their friends. But it doesn't mean that there isn't a group of people that will be interested. The way we would play it, and we don't have any direct plays in it today. We don't have any names where I can say to you, hey, this is a stock we own because of the metaverse. I think the way we play it in theory would probably be to be an arms dealer, right? So we'd want to own a supplier to this space, right? Whether that's a semiconductor company, whether that's a software company, rather than the pure play. Because I do think that, the only pure way to play it today is to own Facebook. And, Facebook will be a relevant company for a long time. And look, it's the way my friends and I communicate, from high school, and we catch up and yada yada yada. But, and this is the big but, and they talked about it at length on their last call, they're losing a demographic that really matters, right? And that demographic is kind of, 14 to 24 to 30, where those users are spending time on products like Snapchat and, TikTok. And look, Facebook has Instagram, and Instagram has tons of traction. But, the ability to compete effectively against TikTok, which has the market advantage today, and Reels, which is Facebook's product, is second. That's not trivial, right? When they made the move from desktop to mobile, that was a transition that they executed beautifully, but they weren't facing a formidable competitor. This time they have a formidable competitor, if not competitors, and I think that they'll get there, but I don't think it'll be that easy. And Reels is a product that needs to get a lot of traction. So I know it's a long-winded answer to why we don't own Facebook, for the metaverse, but we're skeptical on it.
That's all we've got time for. Mike, thank you very much for your time, and I'll hand back to Billy.
Thank you guys. I really appreciate your questions, and hope to make it to the UK here in June, and hopefully can meet with a bunch of our investors finally face to face if the stars align. Although I'm sure I just jinxed it by saying that.
Let's hope not, Mike. Look forward to seeing you then, and thank you very much indeed. I'm sure from everyone who's dialed in, very, very interesting, particularly to hear from someone who's right at the coalface. Thank you so much, everyone who's dialed in, and thank you, Kyle, for mediating those questions. Thank you so much for anyone who's participated in our event, and we hope to be doing another one, I think, in May. So please look out for that. So from me and from the guys, thank you so much. See you soon.
Thank you.